As we are about to leave the current week, we open a window at what next week has in store for the markets. On the monetary front, we expect a number of policymakers of the Fed, but also other central banks, to sway the market's mood. As for financial releases, we make a start on Monday with the release of Eurozone's business climate and economic sentiment indicators for February, while from the US, we note the release of the durable goods orders growth rate for January, and from Canada, the current account balance for Q4. On Tuesday, we note the release of Japan's preliminary industrial output growth rate for January, Australia's retail sales growth rate for the same month, France's and Sweden's GDP rates for Q4, France's preliminary HICP rate for February, Switzerland's GDP rate for Q4 and COF indicator for January, and from Canada we get the GDP rates for Q4 and the US consumer confidence for February. On Wednesday, we note the release of Australia's GDP rates for Q4, China's NBS and Gaixing manufacturing PMI figures for February, while from Germany we get the preliminary HICP rate for February, from the US, the ISM manufacturing PMI figure for February, UK's Halifax house prices for the same month, and Germany's industrial orders for January. On Thursday, we note the release of Australia's building approvals growth rate for January and Eurozone's preliminary HICP rate for February, and the weekly initial jobless claims figure. On Friday, we note the release from Japan of February's Tokyo CPI rates, from Turkey the CPI rates for the same month, from the Czech Republic the GDP rate for Q4, from the Eurozone the final composite PMI figure for February, and the US the ISM non-manufacturing PMI figure for the same month. The US dollar is about to end its fifth week in the greens against its counterparts. On a monetary level, the market's expectations for an aggressive, hawkish stance from the Fed were maintained after the release of the Fed's last meeting minutes on Wednesday. The document showed that the board members generally agreed that the GDP rate in the US is expected to slow down. The US employment market remained tight, while inflationary pressures stepped down yet remained unacceptably high. Overall, despite some members openly discussing the possibility of 50 basis points rate hikes, there seemed to be a majority favoring interest rate hikes of 25 basis points, thus confirming the downshift, yet also the minutes showed a willingness on behalf of Fed's policymakers to keep rates at high levels in order to bring inflation down to the bank's 2% target. Also, on a macroeconomic level, the release of the second estimate of the GDP rate, despite slowing down if compared to the preliminary release, tended to maintain the view that the US economy may be able to avoid a recession, or even should there be one, that would be shallow. Also, the release of the preliminary core PC prices for Q4 more or less tended to underscore the presence of inflationary pressures in the US economy, providing support for the greenback. In the coming week, we expect fundamentals to take over as the number of high-impact financial releases stemming from the US is to be reduced. The pound is about to end the week near the same levels it began against the US dollar, yet is gaining ground against the euro and JPY. The confidence of pound traders got a boost on the macroeconomic level, especially after the release of the preliminary PMI figures for February on Tuesday. Characteristically, the PMI figure of the services sector, which comprises over 60% of the UK's GDP rate, rose beyond market expectations and reached 53.3. The reading did not show just an improvement, but also growth of economic activity for the sector, the first since August. Also, we note the rise of the CBI distributive trades indicator for February, which was able to surface above zero and imply that more retailers in the UK expect their retail sales to rise instead of dropping, while consumer sentiment for the same month also improved. On a monetary level, BOE MPC member Catherine Mann reiterated her hawkish stance, and given the cost of living crisis in the UK, we expect BOE to maintain its hawkish stance. On a more fundamental level, we note the possibility of the UK government reaching a new Brexit deal with the EU, which seems to be supporting the pound, yet a new deal could prove to be a double-edged sword. Mr. Sunak's willingness, though, to seek a change in the Brexit treaty still remains. JPY is about to end the week lower against the US dollar and the pound, yet seems to remain rather stable against the common currency. On a macroeconomic level, we note the drop of the preliminary PMI figure for the manufacturing sector, yet we also note the acceleration of Japan's CPI rates for January, once again contradicting the ultra-loose monetary policy of BOJ. On a monetary level, we note the comments made by BOJ board member Tamura and the warning for the possible risk of a possible overshoot in inflation. He also stated that the bank is to review the effects of its ultra-loose monetary policy in its next meeting in March. We see the case for any meaningful moves to take place after Mr. Ueda takes over as the new governor of BOJ. Yet we would also note that Mr. Ueda, given the comments made at the hearing before Japanese lawmakers, may not be willing to proceed with a radical overhaul of the bank's ultra-loose monetary policy. On a fundamental level, we note the risk of US-Sino tensions being on the rise once again, given also the situation in Taiwan, which may wake up the safe haven qualities of JPY and provide support. The common currency is about to end the week lower against the US dollar and the GBP, while it seems about to remain near the same levels the week began against the JPY. On a macroeconomic level, we got some conflicting messages from the release of the preliminary PMI figures. It was characteristic of the overall situation in the Eurozone that the composite PMI figure rose beyond market expectations, indicating a faster growth of economic activity across sectors and member states' economies. On the other hand, Germany's manufacturing sector PMI figure dropped even further, highlighting a deeper contraction of economic activity for the spearhead of the German economy and the area as a whole. In the coming week, we highlight the release of the preliminary HICP rate for February, and should the rates slow down further, we may see an easing on the pressure which is being exercised on ECB to maintain an aggressive hawkish stance. It should be noted, though, that the ECB's intentions to further rate hikes is considered the current state of affairs, and Valerie de Galau's comments that, put differently, markets have overreacted a little since Thursday, were characteristic. AUD is about to end the week, continuing if not intensifying its weakening against the US dollar. On a monetary level, we note the release of RBA's last meeting minutes during Tuesday's Asian session. The document was characterized overall from a hawkish tone, foreshadowing further monetary policy tightening with more rate hikes to come. On a macroeconomic level, we note the improvement in economic activity for the manufacturing sector as evidenced by the relative preliminary PMI figure for February, while also note the wide acceleration of the CAPEX growth rate for Q4. Among the positives also lays the acceleration of the wages price index on a year-on-year level, despite not reaching market expectations. The coming week, we highlight the release of the real GDP rate for Q4. Also, we note the release of January's retail sales and Q4's current account balance, both being due out on Tuesday. From China, we note the release of NBS and Gaixing PMI figures for February, and should there be growth in economic activity once again, we may see Australian exporters of raw material getting a boost of confidence and the Aussie being supported. On a more fundamental level, we note the possibility of tensions in the US-Sino relationships escalating that could have an adverse effect on the Aussie given the close Sino-Australian economic ties and AUD's perceived riskier nature as a commodity currency. The cat is in the reds against the US dollar for a second week in a row. On a macroeconomic level, we highlight the easing of the core and headline CPI rates on a year-on-year level, yet the acceleration of the rates on a month-on-month level tended to serve as a stark reminder that inflationary pressures are still simmering under the surface. It's characteristic that the retail sales growth rate for December also accelerated, in another indication of the strength of the demand side in the Canadian economy, which in turn may continue feeding inflationary pressures. Hence, on a monetary level, we highlight BOC's hawkish intentions, as they were expressed by BOC Governor Tiff McClellan last week before Canadian lawmakers, which may continue providing support for the loonie. Also, we note that on a fundamental level, oil prices seem about to end the week in the reds, which in turn may have had an adverse effect on the loonie, given that Canada is a major oil-producing country. In the coming week, we highlight the release of Canada's GDP rate for Q4 on Tuesday, and a possible acceleration could provide some support for the loonie. Yet we also note the release of Q4's current account balance, January's building permits growth rate, and manufacturing PMI figure for February. As a general comment, we would like to note that we expect the US dollar to relent some of the initiative towards other currencies, as the frequency and gravity of US financial releases in the coming weeks seems to be reduced, allowing for the greenback's counterparts to shine. Such a plurality of trading opportunities may allow for a more balanced blend to surface in the FX market. As for US stock markets, we note that they are about to end the week lower, as all three major US stock market indexes, namely the Dow Jones, S&P 500 and Nasdaq, are in the reds. The market's expectations for an aggressive, hawkish Fed tend to weigh on US stock markets, yet stock market participants have to navigate through not only the Fed's intentions, but also earnings releases, given that the earnings period is still in full swing. In the coming week, we tend to highlight the release of the earnings reports of Hewlett-Packard, JD.com and Merck among a great variety of releases. Also, we note the drop of gold prices, given that the strengthening of the USD tended to weigh on the shiny metals price, showcasing the negative correlation of the two trading instruments. Also, we note the rise of US yields, which tended to pose a lucrative alternative for investors, in contrast to the non-interest-bearing precious metal. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Hi, good evening. Let me just check the chat settings. Let me share my screen. All right, so hi guys. Just want to check if you guys can see my screen. If you can type it in the chat box that you are able to see. Are you guys able to hear me and see the screen? I will need someone to respond before I can start sharing today's webinar. See someone raised your hand. If you have any questions, do type in the chat box. It's a bit hard for us to catch that function. Okay, I'm assuming the screen is actually sharing fine. You guys can hear me perfectly. Okay, so a little self-introduction. We are bringing you the webinar from the Everest Fortune Group, and we are also the best finalists for Best FX Research for 2019, 2020, 2021, and also Best Equity Research in 2020 and 2021. Okay, so today's agenda will be on risk management and on leverage. So it's a pretty lengthy chapter, this webinar. If we have any extra time left, I'll be doing some live analysis for you guys, and then we can better see today's chapter on risk management, and also what does risk and reward ratio actually really mean. So what is risk management? So risk management is basically a set of rules that governs the trader's actions to protect against the downside of the trade. So many of you might know there's something called stop loss, and as well as a stop loss margin that we are looking at. And then on the second point, since every trader will experience a loss or a series of losses at some point, proper risk management is actually essential for long-term trading success. Okay. So risk is the opposite to reward. I mean, that's very simple. Okay, I will need everyone to actually mute and close off your videos. Okay, if you have any questions, you guys can actually type it in the chat box. All right. Okay, so at which point will your analysis be considered incorrect? So this is where we consider when do we, or what price, at what point that we put in our stop loss, and how much would you lose at that point of time? Have you guys calculated what kind of percentage of a risk reward ratio you guys are putting yourself into once you enter upon your analysis, and the appropriate size for your trade? Tools for effective risk management. Okay, there's 3 types of rules that traders can follow through. One of which will be leverage and margin. Second will be stop loss and take profit. And lastly will be risk to reward ratios, which is the one that I have been talking about. Okay, so first up, we can talk about leverage. So just want to know by a show of hands or a type of yes in the chat box, how many of you actually leverages through and actually knows well enough about the concept of leveraging? Okay, I'm assuming everyone's still pretty new on the concept on leveraging. So let's take a look. So basically, leverage is the ability to control a large amount of money using a very little amount of your own. All right, enter in a position that is more valuable than the amount of money you have in your account. Sounds like a pretty good concept, but it's also a very hard concept to actually grab, right? So leverage is a double-edged sword. So for example, right now you are looking at a capital amount of $10,000. Let's look at the first leverage ratio of 1:20. So you're able to control a position of 200,000, which that will allow you to have a maximum trade size of 2 standard lots. And every 10 pip move, you'll profit in $200 in your capital. Looking at the second leverage ratio, we are looking at 1:100. So you're able to control the position of 1 million, all right, with a capital amount of $10,000, which allows you to have a maximum trade size of about 10 standard lots. So with every 10 pip movement, you'll get $1,000 back in profit. And then lastly, we are looking into a 1:500 ratio, looking at a 5 million controlling of a position, and that gives you to the amount of 50 standard lots, looking at a $5,000 reward at every 10 pip movement in your direction of your analysis. However, we are now going to look at the losses that could incur from the leverage movement. So back to the first kind of leverage ratio at 1:20, we are looking at 2 standard lots. With every 10 pip, your losses will go to $200. So basically, it is the same as the amount of money they will gain if it works out according to analysis. And then we are looking at the losses as well. So for example, you take the last ratio, the last leverage ratio, 1:500, giving you a controlling of a position of 5 million. 50 standard lots. So every 10 pip will cost you to lose $5,000, right? So that will actually take an impact on your capital amount, just by that's as equal as 50%. So leveraging might sound great if you are all winning or profiting and your analysis just so happen to work out fine. However, if you are losing, you could lose your account to a margin call really, really fast. So let's look at margin right now. So margin is the amount of money that trader need to put forward to open a trade, and then margin level equals to equity divided by use margin times 100 for percentage. So for example, we can take a look right here. If you're using the ratio of 1:100 leverage ratio, use a margin percentage of 0.01 equals to 1%. So buying 100,000 euros with the current price of 1.04 USD with a 1% margin, your required margin would be at 1.4K. Margin level equals to 10,000 divided by 1.4K times 100, that will be 714%. So I did mention about margin call just now when we were talking about the losing of a profit. So you can see that margin call level is when the margin falls to 100% and unable to open for any more trades. And margin call equity falls below 100% of the margin required. You will have to deposit more cash to sustain the position. If not, the position will automatically close out. So let's just say talking about stop out. So free margin falls below 50% of the margin required, positions will close out automatically. So how much risk should we actually allocate to a trade that we deem worthy or we want to look at? So before I move on with this topic, is there any questions on the content that I have shared before this slide? Okay, so I guess we're all good. Let's look at risk allocation. So risk allocation actually basically means risk per trade should always be smaller percentage of your total capital. So for example, you are putting 2,000 out of your 500,000 kind of trade. So you're looking at a very small percentage of your total capital. So typically the maximum loss should be allowable no more than 2%. All right, 2% is a good gauge. I mean, there are many different kind of risk takers, right? We have the very, very safe kind. We have adverse risk takers. So we are looking at normally when we advise, when we are sharing this kind of risk allocation content, we will normally tell our attendees that maximum loss shouldn't be allowable more than 2%. All right, that also depends on your experience level and trading style. So in comparison to a $10,000 account, we are looking at one trade for $200 that will equals to 2% risk and 5% risk at 500. So we are looking at a series of numbers of trades. We have 2, 3, 4, 5. So if let's just say if you are putting your account at maximum of a 2% risk and you take 5 trades, and that will amount to $961 out of your $10,000 account, coming up to about 10% of your account. And then if you are taking a 5% risk per trade, then we will be looking at $2,262 after all these 5 trades technically have lost, or we are risking the amount at a 23% mark. So what is the ideal percentage per trade? All right. So I mean, it would be great if you guys can pitch in and tell me how many percent do you guys actually normally risk per trade? Or you guys can look at these numbers on these slides and give a gauge. We are looking at 1 to 3%, 5%, and 10%. So what is your ideal risk appetite? Okay, so I have most common answers at 1 to 3%. I think 1 to 3% should be relatively safe, but so what is the ideal one that we are looking at? So for example, you have $1,000 and we are looking at a roulette here. Bet on the black to win, there's about 48% chance to win. So how much would you bet? It's a very simple math gambling question, right? So let's just say we are betting on black and you have 48% chance to win. How much would you bet it? Basically, the more you bet on it, the more you would lose. It's a simple math. So even though the percentage of winning is at 48%, which is pretty high for out of 100%, however, the more you bet, the higher chance and the higher risk you are taking in terms of this roulette, for example. And then let's just say, in this case, sorry, I think there's a typo on the slide. So in this case, if you are betting on red, so how much would you bet? So you see, it is the same concept, however, with a lower probability of winning. However, the amount of money you're putting in will increase the risk because of the lower probability. So how many pips should your stop loss and take profit be? So I know that this can be super subjective. Certain people look at the pips, certain people look at the horizontal support and resistance level. All right, so we are looking at how many pips per se. So I mean, if you guys have exact how many pips you guys actually follow through while you are trading, you guys can type it in the chat box below. However, I feel that there are many other ways to look at it, not just pips. So if we have time for the live analysis later on, we will look at how are the other ways of putting in your take profit and stop loss. So we also have to understand risk. So understanding risk and what is your ideal lot size. We have 0.1, 0.3, and 1. So how does lot size affect your stop loss? How does lot size affect your stop loss? So we are looking at the graph here. Account size at 50,000 USD. Currency pair looking at Kiwi dollar. 1% of the account at 500, 2% of the account at 1,000, and 3% of the account at 1.5K. So we are looking at a stop loss of 50 pips, and we are looking at a take profit of 90 pips. Okay, so in this case, the lot size do affect your stop loss. For example, you are looking at putting a stop loss at 50 pips away. However, your lot size is in a huge amount, a huge lot size. For example, you are looking at 1 standard lot, right? If you're losing all the way at 50 pips, that will allow you to might get into margin call. All right, so lot size do affect your stop loss. All right, however, if you guys are more keen on looking at pips instead of a how do I put it? Capital margin level. So do calculate against your lot size. So for example, if you're looking at 50 pips stop loss, use that to backwards calculate to your account and what is the appropriate lot size for you to enter for this trade. So we can also take a look at the pips, right? So let's look at 50 and 90 pips. In this case, you will see that, 50 against 90 pips looks like a very big risk and reward, right? So let's look at the next slide. We're looking at 20 and 36 pips. Yes, it looks like lesser pips, looks like a lesser, more safe kind of trade. However, they are the same. All right, they are the same if your lot size is the same. It's because the risk to reward ratio is the same, right? So if your lot size is according to pips, then this will be safer. However, if you are comparing risk to reward ratio in terms of percentage, they are the same. All right, so this is one tricky thing that sometimes people are not reacting to the number of lot size. Sometimes people are not considering the risk to reward ratio when they're entering the lot size, as well as looking at an effective stop loss. Yeah, so you can see that there's two taglines here. It's not about the number of pips you make, it's about the risk to reward of your trade. So look at the ratio. I think risk to reward ratio is really very important in this case. So for those that are wondering how we got the pips, you can look at the entry price on the left, on the right, okay? So stop loss and take profit placement. So where is the appropriate place, appropriate price that you guys technically should look at during your analysis? All right, so first point would be, rather than considering stop loss and take profit levels as fixed pips amount, stop loss and take profit levels should be placed on technical levels on the charts, right? Some traders are super fixated on the idea of, I will only put my stop loss at, for example, 15 pips, 20 pips, and I will not take it beyond that. But how sometimes putting stop loss according to pips might affect your analysis in terms of you're not allowing your analysis to have breathing space, you're not allowing the market to correct to your analysis, you're not allowing the market or the price to actually move as per what you're looking at. Okay, so instead of looking at a pip level or pip amounts, stop loss and take profit should be placed on technical levels on the charts, which is also our important horizontal levels like your support and resistance and historical price values. All right, so one of the example will be shown in this chart below. So stop loss beyond and take profit before. So normally stop loss will give it beyond the resistance or slightly above the resistance or the support, depending on the direction you guys are looking at. And take profit will normally try to put it slightly before what we are looking at, slightly before the resistance that we are aiming to target to, and slightly before the support we are aiming to target to, which actually allows our analysis to be able to follow through and take profit and stop loss when it is absolutely necessary. All right, so one of the example is shown here. In this case, they are looking at a sell, right, from the major resistance area on the yellow line. So you can see that by right, resistance should be at the tip of this hold on, so normally it should be at the tip, right? However, we are putting it slightly above, so we can see the red lines, stop loss, slightly above, just slightly above the resistance level. And then we are looking at below at the major support area instead of resistance, sorry, that's a typo, major support area. We are looking at a support of the yellow golden color line, and then we can see that the take profit we did indeed put slightly above the major support area. Okay, that's one way to look at when you are putting stop loss and take profit. I mean, it's a very good guideline if you want to put it right on the resistance area, it is doable as well, or right on the support area, it is doable as well, depending on the situation of the analysis. So what is a healthy risk to reward ratio to have? Risk to reward ratio helps investors manage their risk of losing money from a series of bad trades. It's essential for traders to identify positive risk to reward. Typically, it's suggested to have 1 part of risk and 2 part of rewards. So 1:2 ratio. All right, very simple, just 1:2. Preferably, if you can keep the risk down for a 2 part of reward, it would be great as well. But theoretically, 1:2 is a good ratio amount we are looking at. Yep. So here comes the hurdle. So a fixed risk to reward ratio could also pose as a difficulty for most traders. Something to consider in addition to risk and reward is the winning rate. So let's look at risk to reward ratio versus the winning percentage. So trading strategies win rate, let's look at 80%. So your risk to reward ratio will come down to 1:0.25. Meaning we are looking at a sorry, it should be reward to risk. Okay, so in this case, the chart is being plotted against reward to risk. So let's just say your winning strategy is at 80%. You are rewarding yourself at one part with 0.25% of the risk, and then so on and so forth, all the way to 20%. So let's just say your strategy win rate is very low at 20%. So you're actually exposing yourself to 4 parts of risk when you're only earning one part of the ratio or reward. All right. Oh, thank you, Juha, for telling me. Okay, so apparently the chat box is not working fine for everybody. If you guys have questions, you can put it in the Q&A box as well, I guess. Yeah. Okay, so let's move on. Okay, that comes to the end of this chapter on risk and reward ratios and leveraging. So we do have some time left, and I think it would be great if I share some live analysis, and it would be great if you guys wanted to pitch in to look at some pairs and we can analyze together. Okay, hold on. Let me stop my screen. Let me just switch over to the trading view. I think I need everyone to mute the mic. Hold on. All right, hold on. Let me just share my screen real quick. We are unable to give WhatsApp line. If you guys have any more extra questions, I will show you a platform later on where you guys can access and ask questions. All right. So let's just hold that till the end. And let me share my screen right now. Okay. It'll be great if you guys can let me know that you can see the chart. Okay, I believe it should be sharing fine. Oh, okay. Thank you. Okay, let's look at what we can see on dollar yen. We'll look at the weekly chart. Pretty good upward movement for a while. Looking at a potential downfall, further downfall. Okay, let's look at the daily chart. On the daily chart, I can pretty clearly see a ascending channel prior to the downfall. You can see that actually price has already broke out the channel. We are looking at a potential drop from here. Right now we are looking at a resistance, support term resistance at price 142.078. Okay, on the daily chart, let's look at a 4-hour chart. I would say that on a 4-hour chart, the trend itself is not quite as clear. However, we are looking more of a ranging situation at support at 138.51. Let me just change this. Okay, and we have resistance at 142.078. So previously, price indeed dropped and did a little bit of a pullback, and we can look at a common V shape that we are looking at. I would say the overall day and weekly chart, we are looking at a downward fall. I would much rather analyze this to be a downward fall, looking at this and placing a nearer take profit. And putting a slightly above, just touching this, looking at a slightly above trade stop loss. This is how I am viewing it. We are looking at a potential sell. Let's take out the Fibonacci retracement. We're closer to a 50% Fibonacci retracement for our take profit. And then let's do a smaller one, actually. Yeah, looking at the sell entry at 50% Fibonacci retracement as well. Let's take out our... We are also looking at a... Sorry, this is wrong. Let me just take... the 1.8% of stop loss. We can use this range, so we are looking at a bigger range for stop loss. We can also take a look at our and let's take a look at some indicators. Yep, we are looking at a more likely to be downward fall. Let's take out our lagging and leading span. So price try to break out of the Ichimoku cloud. We're looking at it to turn back down. So we are more likely to look at a potential drop. Stochastics are also looking at a potential drop downwards as well. It depends. All right. So we are also looking at a small upward channel. Okay. So if those that are concerned with this upward channel, you guys can wait till the price to actually exit the sale entry. I mean, to exit the upward channel before doing any sale. So we can remove this 50% retracement and change it for a 38.2. And then if price actually breaks out of this upward channel, then we can confirm a better sale towards it. All right. So in this case, if you guys want to, you guys can actually put a closer stop loss to make it lesser than 1:2 part. All right. So this is dollar yen. We have any questions or any requests? Okay, so we can look at, I think from the weekly chart. Previously was a upward moving. All right, still upward moving actually, but looks kind of odd. Looking at something like this. Okay, we can look at a historical price level in March 2020. Looking at this to be a resistance level. However, our more recent resistance level, we are looking at 1.38821. Let's take a look at our daily. We have a clear sign of downward trend. And there was a certain pattern. This is what I have spotted on a upward trend. So let's just say if this is 100% accurate, then we will be looking at a downward fall. Around this area. So yes, indeed, it is a downward moving trend. Let's look at the H4. Can be seen as a channel, but not a very pretty one, I would say. However, we are still looking at a downward fall. Looking at a resistance level of 1.35355 to the most recent highest amount, we are looking at a general downward fall. I will not put my take profit to be 1.29862 because price is a bit far away. Normally I do analysis that has a greater potential to complete in the same trading day. We are also looking at a forecasted entry that is a bit far away. It's a few bars away. So you guys can take into consideration and analyze it on your own POV. All right. Let's look at where should we place our stop loss. If I were to put it on this right shoulder resistance, it'll be too far away. It'll be 1:1 risk to reward ratio, which I'm not in love with. So I'm looking at a Fibonacci to help me out. So we are looking at a take profit at 78.6% Fibonacci projection. Take profit. This is a sell. And then let's take a look on how can we get our Fibonacci projection for stop loss at 1272. So we are looking at using Fibonacci projection. We're looking at 1272% as a stop loss entry. As a stop loss entry at 1.36131. All right, so this is what we are looking at. It's sort of a forecasted sell entry, is a bit far away, but looking at previous 2-point touches, we are looking at this is to be a probable resistance level that we could be looking at. Then we can also look at a indicator. We're looking at a bearish movement right now for Ichimoku cloud, not very pretty. We can look at RSI. Also looking at a potential reach in resistance, and we are also looking at a downward fall. A very gradual one, but you can see that it's a downward fall. So this is dollar CAD for you guys. Okay, I'll be doing one last pair before I share the platform there. You guys can get in touch with us, and also a special Black Friday promotion. One last pair. Okay, let me think. We can do dollar franc. Let's do dollar franc. Let's do dollar euro. Okay, dollar euro. On the climb for dollar euro, you can see a very standard upward moving trend. Looking at a weekly chart. Upward moving, not much of a key levels except for resistance at 1.0303. Let's look at daily. Previously upward moving trend has now dropped down. So we're looking on the decline side of things for dollar euro on the daily. And let's look at 4-hourly. 4-hour mark. Okay, so previously was a pretty steep downward channel. It looks like price has actually gone up a little bit, a fair bit. And then we can see a slight upward moving. If you guys really want to, you can do a very small analysis here. Just right below the support area. Let's use Fibonacci projection, looking at a 78.6%. Yeah, there we go. We have a 78.6 for the buy entry, and looking at 1.272%, which is 127.2. Looking at a stop loss over here. However, this is a very small trade. All right, so for fast and quick movement actually for euro dollar. Let's look at some indicators. You can see the price is still struggling to actually break through the cloud. Okay, if you guys are fond of Ichimoku cloud, you guys can wait till price actually exceed the cloud to take a movement. All right, whatever analysis right now I'm doing is purely based on the price action and not reliant on the indicators. Okay, so indicators are just supporting for me. So you can take a look at stochastics. Yeah, so we are pending the blue line to actually cross over the orange, so which is our percentage K to cross over our percentage D to have a better confirmation of a buy entry. Okay, that is for euro dollar. So let's move on to the VIP room. All right, so actually IronFX actually had partnership with our company to actually create a VIP room for you guys. Okay, so we are looking at a platform which allows you guys to actually interact with us on a daily basis to catch up on daily news, majors analysis, like we have euro dollar, pound dollar, dollar franc, dollar yen, Aussie dollar, Kiwi dollar, and the XY, which is your dollar index. Okay, so let's take a look at the platform. All right, so every day there will be important news that you guys can actually look at. There are forecasts that you guys can consider to take note in your analysis. So you can see that there are so many news for each currencies, major currencies on daily. So there's euro, pound, USD, of course, yen, we have the Aussie, Kiwi, and we also have commodities, which are our oil, as well as gold, which is a very popular pair as well when you guys are trading. So let's look at some of the majors analysis. So on a daily basis, we will also post analysis that you guys can consider and also discuss. So for example, I would like to discuss with him on this, and or just want to ask on the page. So for example, let's take a look at let's just say I want to put in a Fibonacci for this line, please for support. So I will say, hi, with this Fibonacci. So one special function that allows you guys to actually fully interact with us would be to link object to text. Okay, so I selected the Fibonacci extension with 0.786 lines and confirm, and I'll post. So once I posted it, if I hover over, you can see that there's a blinking red color Fibonacci line, as well as on your percentage line. You can see that, oh, we are able to understand what you're saying. So let's just look at some of their highlighted levels. You have the first resistance, the Fibonacci levels, second resistance, etc. So this allows you guys to actually interact and also look at our analysis on a day-to-day basis, which would be beneficial. And it's an open space, especially created by us and IronFX in partnership for you guys to actually have this exclusive website for everyone to interact and also look at the charts together. So we also have commodities. We have gold and silver. We also have your Brent crude oil, WTI, natural gas, and looking at soybean and corn as well. We also have your indices, your S&P, your Nasdaq, your DJI, your DAX, Nikkei. We also have crypto, Bitcoin, and ETH. All right, so we have our crosses as well, our special crosses that you guys want to see. It will be also available on this platform itself. So how do we get in? So normally on the IronFX account, you guys capital has to have a certain level. However, now it's on a 50% off. So what does that mean, right? So let's look at it. So for silver account, initially your initial capital in the IronFX trading site has to have $1,000. So now it has gone down to 500, 1,000, 2.5, and 7.5 for all of the different level and tiers of VIP account. However, starting with 500, you're able to access everything that I've been talking about over here. Okay, so you can look at, so some of the benefits will be exclusive market forecast, and then you're able to interact and ask questions about analysis. You're able to request market forecasts as well, personally to you. So just to take note, the Black Friday promotion will last from 21st November, 2 days ago, until 28 November. All right, the year has to be updated. Sorry, should be 2022. All right. Let's look at so your access. So step one, you just have to have a IronFX account and then log in to client portal and select VIP room. And then during the course of promotion, you just have to deposit enough funds to access the required account level of your choice. And lastly, you'll receive a verification and proceed to verify your email to access the VIP room. Okay, so you can also click on this tutorial. So it will be shared on how you can access. All right, so I'll be giving this page to you guys on the chat box. Okay, so you guys can look at this. So can also share with you guys the website for that. All right, so you guys will be able to register from this website itself. All right, is there any last questions? Any last questions before I end the webinar? Oh yeah, for the attendee that was asking for the direct communication, this will be a perfect platform for you to have a direct communication, and best with a Black Friday deal of 50% in partnership and thankfully for IronFX. All right, so if there is no more questions, we will be ending today's webinar. All right, thank you guys so much. Thank you.
my name is Christina and welcome to another educational video. The terms mine and yours were used by traders on the trading floor to signal buying and selling of securities. The term mine was a buy reference while yours was a sign that an individual wants to sell an order. These terms were used with other similar terminology in the open outcry system. This system refers to the trading pits before 2010, where traders used verbal communication along with hand signals to convey trading information. In these marketplaces, large group of dealers and brokers engaged in competitive buying and selling. The words mine and yours were used to express the intention to buy or sell, respectively. Both buy and sell were also common. For instance, a dealer in the interbank market might type or speak mine to a counterparty of broker if they wish to purchase a specific currency. The trader will say yours, signifying it's yours if they were to decide to sell. In the same way, if a floor broker offered 100 call option as $1 each and a market maker decide to purchase them, they could respond by shouting mine to indicate their intention to do so. Both of these words were used to enable quick and precise transactions in a market that was frequently chaotic and active. Today, the words mine and yours are both still frequently used, mostly in the Forex market. Additionally, they continue to be employed in the same context as they did under the open outcry system. Thank you for watching.